Hey traders, this is Blake Morrow with Trader Summit, and happy Friday. You know how I know it's happy Friday? I got Jim Welsh from Macro Tides. Let's bring Jim in. Jim, how are you today? Good to see you.
I'm doing good. Happy Groundhog Day, by the way. And the fact that they're seeing our two faces together probably makes a lot of people happy, not so much because of our mugs, but because it means it's Friday.
It's Friday. I don't know. I think you're giving us too much credit here. I think everybody's happy because they have a 5,000 cap S&P
Wow.
cap on their head, and we're about there.
Yeah, we're working on it.
We're working on it. So hey, it was a huge week in markets, huge, like ginormous.
Yeah.
I mean, QRA, FOMC, Bank of England, lots of
Economic data.
lots of labor data. We had
Yep.
we had the jobs report today. I mean, and we're ending the week right now at all-time highs on the S&P. You told us we're going to get to 4,900. We're at 49 and change. I know we're going to talk all about that here in a minute,
Yeah.
but great call.
Yeah. Well, let's talk about the Fed. Again, people were astounded by Chair Powell's comments because, again, if we go back to December 13th, after his press conference, a lot of people were like, hey, Powell did a 180. Now he's a dove. And I went through and we talked about it back then, that was a completely mistaken view for a lot of reasons. We don't have to rehash that. And my take all along has been they weren't cutting in March for a lot of different reasons. My only surprise, Blake, is that Powell, I thought he would be non-committal. What I wrote this past Monday was he's going to be a two-handed economist. He's going to talk about, hey, inflation's down, isn't that wonderful? But hey, the economy's growing faster than what would be commensurate with us achieving our 2% inflation. And he kind of did. The surprise for me is that he went so far as the odds of us cutting the funds rate and the committee getting to a point of having real confidence that we're really going to get to 2% is low. So a rate cut in March is unlikely. So I didn't think he would commit one way or the other. And instead, he committed more to the side of it's not looking good in terms of the odds of a rate cut in March.
And the market took that for a day, intraday, ran
Yeah,
with it, and we
right.
we we saw the market go, oh crap, we're not going to get this rate cut that we thought in March. Looks like we're going to have to wait till May, but it doesn't matter. We're still at all-time highs. So
Yeah. Well, and not what they then shifted, which is kind of remarkable. Okay, so the Fed's not going to cut in March. But now we kind of think that they're going to throw in one or two 50 basis point cuts some point in time in 2024. So all is well. Seriously.
that's
Okay, that's why the market rebounded yesterday.
that's
Yeah,
what they're doing, right? Like I still don't hear
yeah,
you. All right,
yeah.
no, I still don't hear you.
No, so again, the only way you get those cuts, in my view, is the economy slows a bunch more than people are anticipating. Obviously, Powell's decision or his comments look prescient in the sense of the jobs report. The JOLTS report came out. We saw an uptick there. Now, both reports, the response rate has dropped significantly. So we're getting fewer and people responding to those surveys, and which makes the data maybe a little bit less reliable. In addition, the January employment report is notorious for the seasonal adjustments that are made. Plus, we had, as we might remember, an unbelievably deep cold wave that affected a large part of the country in the middle of the month of January, which I believe coincided with the week that they took surveys. So my only point is you got 350,000 jobs, and we saw hours worked drop to the lowest level since March of 2020. So, I think if one wants to look at some of these numbers, is okay, employers are hanging on to people, but they're reducing their wages. They're trying desperately not to have to let people go. What does it mean? You added more workers, but they're working shorter work weeks. Well, what happens to weekly net pay?
Yeah.
Well, it's for the people who are working, their weekly net pay is shrinking a little bit, and that's on 100 and some million hourly workers. So again, there's a lot of craziness in this data point, but you got to sometimes take at least some of it at face value. And this data obviously supports the idea anybody looking for a rate cut in March or 50 basis point cuts, you got to kind of dial it back.
Okay, real quick before we get into your charts that you brought, I do want to ask this question. So what you said, I agree with you. The only way the Fed gets to where the market is expecting is for the economy to slow down aggressively. But does the Fed, even while the economy is still strong, is the Fed, do they have the argument to even cut, just go out to May? I mean, let's just say we stay status quo. We create
Right.
inflation is kind of where it's at right now, above the 2% target, but still just kind of sticking around current levels.
Yeah.
Let's say we're still creating jobs every month. And the underlying, what everybody's
Growth
seeing
is
in the
okay.
economy seems okay.
Yeah.
Can you still argue that the Fed should cut rates in
Yes.
May? Why?
Yeah.
Why?
Because the real funds rate is historically, relative to the last 30, 40 years, relatively high. So the point being is that the drop in inflation, and as we talked last week, we're going to, in the next 2 months, or the two reports coming for January and February, we're going to see even more declines in inflation. I think the argument of, hey, wait, we have a real funds rate that is pretty high. Can we cut 25 basis points? Yeah. Is that going to make a huge difference? Probably not. So to me, the argument as we go through time of at least doing a token 25 basis point cut and then waiting another couple months and maybe doing another one, I think that's what the base case. That's what I think the base case is going forward. In other words, no rush to cut aggressively, certainly not 50 basis point leaps. But I do think it makes sense for them to, and I do believe this is the path they're on, Blake, that, okay, we're going to cut modestly. Just like what we saw, it's a rewind of what they did on the way up. Huge increases, and then they shrank the increases, and then they stretched out, they started skipping months on a couple increases. Well, I think they're just going to unwind that backwards in the sense of, okay, we'll cut by 25 basis points, then we're going to skip. And then we're going to cut maybe by 25 basis points. Again, I believe, and okay, it's interesting, and I got to get Powell's transcript. I haven't a chance to read it, but he made a comment to the effect that, unemployment and growth isn't going to keep us from cutting rates. Now, I think there's truth in that statement. At the same time, I think it's a response because Powell got a letter, or the Federal Reserve did, but it was directed at him from Elizabeth Warren, a number of other Democratic leaders, urging him, telling him to cut rates. So this is him being able to say, hey, we're holding off, but we're not holding off because we want to see unemployment go up or we really want to see the economy slow. So that was, I think, his response of saying, you know what, you're asking me to cut rates, and I'm not going to allow you down the road to use any comment I make about unemployment, labor market having to ease up a little bit, economic growth slowing, because that'll give you, more juice. So to me, that was like a preemptive point. In reality, I can't believe that the level of GDP growth and the tightness in the labor market at the point where it is right now isn't going to have an impact on how soon and how aggressively they would move to cut rates if, as you premised, everything stays pretty status quo the next handful of months in terms of growth, inflation coming down, and so forth. Again, we're in an election year. Politicians are going to trip over themselves looking for anybody they can point to, and criticize. And there's no love lost between Elizabeth Warren and Jay Powell.
Well, I was going to say, so is it that same group of Democrats that gave us this huge beat in jobs this month? Oh, I'm sorry. You don't have to answer that. Let's go ahead and get to the charts, Jim. No one believes that, right? No, no one. So the first chart you bring is the real Fed's funds rate
Yes.
and minus inflation expectations is restrictive. Now, this goes back to your point you were just making a moment ago.
Yeah. Yeah. That in part why I kind of led up to it. The darker blue line is the real funds rate. I'm going to try to dig out, if I can, a chart that shows the funds rate relative to like the core PCE or even the headline PC or core CPI. Because inflation expectations to me are a little fuzzy. However, what we can see going back as historically, when you got progressively over 2%, it represented increasing tightness of monetary policy. Real rates were high, and ultimately you wound up having in a recession. Those vertical shaded areas are recessions. As I pointed out last week, we've seen a significant easing of financial conditions based on market indicators. S&P rallying, Treasury yields coming down, dollar weakness, yield spreads narrowing. But on Main Street, financial conditions, really, other than mortgage rates, haven't eased at all. If you're a small business, you're still playing prime plus a spread. If you're a consumer, your personal loan rate, your credit card rate, your auto loan rate, they haven't really budged. So this is where, again, the real funds rate is restrictive in terms of its impact on Main Street.
Okay. All right. Well, that's fair. I mean, that makes sense. And I guess that it gives you that argument that they could realistically still cut and in current environment just to because the real funds rate is too high.
Yes. And the Doves on the FOMC, this is their point. This is their talking point.
Yeah.
Is, as inflation continues to come down, the real funds rate goes up. And it's a legitimate talking point. At some point in time, I think, the Fed will decide, okay, here's a 25 basis point cut, in a sense, to acknowledge the argument being made by the Doves.
All right. Fair enough. Okay. Well, let's talk about the dollar because the dollar has been on both sides of the range. I call it the edge of the
Yeah.
sandbox, if you will. We've been all over the map. We're closing in
Yeah.
on our highs of the week, but we were just at the lows of the week about 2-3 hours ago. So,
Yeah.
this
Yeah.
is our week in trade. So, are you still expecting the dollar to move higher here?
Yeah, the expectation was that we would see a pop above that 103.81 high, and ideally, somewhere around 104, 104.26. That's way for a lesser degree. Those were two reasonable targets. I believe that if and when the dollar gets up there and rolls over, it will mark a top of some significance. So we're approaching a point in time where we can be looking for a high in the dollar. And ultimately, Blake, I think we're going to see the dollar drop below 100 and potentially 90, get down towards 96. Whether that happens in 2024, we'll have to just see how it plays out. But we have 5 waves down from the high at 107.34. So from my perspective, that says, okay, the longer term trend is now down. With the 5 wave down there, it's like, okay, we're going to get a rebound. The obvious target was 104.26. We've been talking about this since really late December. So nothing has changed. And in the last couple of weeks with all the choppiness, it was like, hey, as long as the dollar holds above 102.80, I think it was, the door to this move up is open and likely.
So Jim, you're really talking my jam here because, I like to trade currencies. But before I get into my next question, let me just say this. If you like what Jim's saying and you like these videos that he does every week with you to give to you, the viewer here at Trader Summit, make sure you jump down below, comment, give him a thumbs up, subscribe to this channel, and hit the bell icon so you don't miss any of these interviews. I just wanted to make sure I got that out of the way because Jim, we meet here every week. But the question I wanted to ask you is, And I was posed with a good question this week as far as the currency market goes. Right now, it's the race to which country, which currency, which region starts cutting rates first. I mean, obviously, we got emerging market currencies or countries are starting to already cut rates. But if the dollar is really supposed to get hit from here,
Yeah.
that would suggest that the Fed is going to cut rates before probably the European Central Bank. I don't know. I look at Europe and I think they got a lot of problems. So, do we have to start paying closer attention to the European economy if we're trading the dollar now?
Well, I think the European economy, if not in a recession, is going to be in a recession. So that's a given from my perspective. All right. Again, the idea that we were going to get this rebound in the dollar was predicated on they're expecting cuts in March, 6 cuts in total. We're going to get enough economic data that kind of blows back against that.
Yeah.
I believe we're going to see the economy slow materially as we approach the middle of the year. And I think that's going to be a negative for the dollar. So I'm going more by the chart than anything else. I think the ECB will be cutting rates. The exact timing, hey, it's up to what's her name? We're going to see rates come down in emerging markets. So all that is coming. The key comes down to the degree of economic weakness that we see starting to unfold in the US. I think that's going to be the driver of that whole dynamic. And it's like set up perfectly. As we know, for much of the last year or so, people were looking for a recession. Now it's like, we don't have to worry about a recession at all.
Yeah.
And as we've talked, the inverted yield curve has a lag time of 19 months. 19 months from July of 2022 when it inverted is January of 24. And if something has an average of 19 months, that means there were cycles where it was longer than 19 months.
Sure. Yeah.
So, everyone has dismissed the inverted yield curve because, it hasn't happened.
It's broken.
Yet.
It's broken.
Yeah.
Broken.
So I just think it's just psychologically and from a contrary point of view, looking for the economy to slow more than expected, I think is the right call. And things like this jobs report it gets people even more convinced. Hours worked, that's a tell of underlying weakness. So anyway, the dollar, I think, is going to have a fairly significant decline during the course of this year, at under 100. And then we'll see just, as it starts to progress, what the pattern looks like and so forth.
Okay. I'm still not on board with that, Jim, but that's me. And that's what makes a market, though. We can agree. There's definitely things I love your analysis, but with the dollar, I still don't see it. But you know what? That's
now,
great.
Do you think the dollar's just out of, or so you kind of taking the view that the dollar is going to continue to work higher?
I am. But
okay.
And it's mostly just from central bank divergences.
Got it.
I still think that our economy is going to be doing better than most other economies. So that U.S. exceptionalism that was so strong last year is going to rekindle or reemerge. If you
yeah. Hey, it definitely could unfold that way.
Yeah, and look, it's this is what the charts are telling you, and it doesn't necessarily mean that we'll find out. Time's gonna tell. But that having differences of opinions are good, but it also could tell you how challenging things might be. And you take a look at gold, and this is the chart that you brought in gold. There are bulls and bears squarely on both sides of this argument. So tell us where they should be right now.
This is a tough. I thought if gold closed above 2040, that's the downward sloping trend.
Yeah,
that would set the stage for at least a rally to 2061. Clearing that, you'd ramp higher. Well, we got it yesterday and it faded, and obviously getting beat up today. And so again, looking at this pattern, the thing that sticks out to me is you got 3 waves up to 2122, A, B, C. And that's a 3-wave rally. So the action since then, can be interpreted more than one way, which is that's the way it is sometimes a pattern analysis. There's times when things are really pretty clean, and then there's times where it's like, wow, I'm going to run out of letters to label this chart, right? My concern is that you had this breakout and immediately reversing, getting below 2010, I think would be a negative. And obviously that trend line, I think, is down a little bit further. I think it's around 2010-ish.
It's like I had 2020, but yeah, I think we're
Yeah.
probably right around those levels. Yeah.
Yeah. It just, again, one of the patterns that could be is you had a rebound to that 2088, then a leg down, then an A, B, C up to yesterday's high. And now we're about to start a pretty intense phase of a decline. That's can't be. So to me, the only way to trade gold is using, I think, relatively tight stops based on whichever pattern you're running with.
Right. Yeah.
Until, I mean, it's basically going in this narrowing a triangle's being formed here. Something's going to give.
Right. Right. That's a great point, Jim.
So,
All right.
yeah.
Triangles are dangerous, especially when you're in the midst of them. It's that
Oh,
apex, you
oh,
get whipsawed and your neck breaks, it's
yeah.
crazy stuff. So
They are a royal pain.
a royal pain, speaking of a royal pain, I was looking at TLT and the 10-year, and it was looking so bullish up until obviously today.
This morning.
So what happens here now?
Okay. Well, my view is that you can see a 5-wave rally from the low last October in TLT, which is equivalent to the Treasury bond prices. That implies, in my view, that we're going to have a correction and then another pretty significant rally after the correction. I thought that the drop down to 93.10 was most likely a wave A of that corrective phase. My guess was that TLT could rally to 96.50, 97.50. Obviously, yesterday exceeded that by not a whole heck of a lot. And we obviously broke below hard so far today. What's interesting is that you can see down there, I have the 50% retracement of the rally from 82.42 to 100.57 is about 91.50. We look at how this correction is unfolded, Blake. 100.57 down to 93.10 is $7.47. Subtract, if A and C are equal, 747 from 98.67, and you get 91.20. So my take is that, okay, we're getting this correction. And then I think there's another significant rally in TLT, as I've been saying really since October, a move up to 105, 109, outside chance of 119 is what's coming. What will drive that? It's either a geopolitical event or the economy slowing down on its own or because of a geopolitical event.
That actually matches up exactly with which would be inverse of your dollar thesis as well. So
yeah.
And if I had to say that, then it probably is more less geopolitical, more slowness of the economy, because the dollar would probably be a beneficiary in a geopolitical flare up, if you will. And hey, we just got a ceasefire this week, apparently, or at least closing in on one. So we'll see.
We shall see.
All right. The next chart you brought up, Jim, is the S&P. Now we are here, and I have to say you've guided us to 4,900. You've been real adamant about that. But before we lit up the cameras, you said you were a little bit concerned. So can you talk us through what you're thinking here on the S&P?
Okay. So what we can see is from the January 5th low at 46.82, marked in blue, I think is pretty clear. 1, 2, 3. The decline into the low on Wednesday was an ABC, 3 waves down, obviously reversed very hard, which implies to me that was wave 4. We're in wave 5. If wave 1 and 5 are equal, it suggests 48 49, pardon me, 65 is the high. This title up here was last week. I said, okay, expected dip to 48.65. It got down to 48.45. Must hold 48.40, which it did. And then a wave 5 rally to a top. So you add 120 points, which was the length of wave 1 to 48.45. That's where you come up with a guesstimate of 49.65. I think that's wave 5. Now, the S&P right before we started was up about 40 points. And right before we started, I looked at how many stocks were up on the New York Stock Exchange and down. At that time, there were 700 stocks down and 2,100 stocks, 700 up and 2,100 down. The Russell
That's
2000.
crazy, Jim. That's
It
crazy.
is. It really is. I mean, it's kind of extraordinary. It again
Say
shows
that slowly
underlying
one last time,
weakness.
because people are like, wait, what did he say? Say it slowly one last time.
What? That you
Your
only had
statistic you
700?
just about
Yeah,
700
700
stocks
stocks
versus
up.
2,100. Yeah, go ahead.
Yeah, done. All right. So that shows that there's a lot of selling pressure underneath the surface of strength, with the S&P making a new all-time high. The Qs, I think, are going to make a new all-time if they haven't already. And we're going to get to that in a second. The other thing is, I talked about the Russell 2000 and how important it was to get above 1990. And if it did, I thought we'd keep running up towards 2050 or something like that on the Russell. It got above 1990, then was closed well below it on Wednesday. I think it might have been up a little bit yesterday. And the last I saw it was down, the Russell was down 12 points. So my point being is this diversion between various averages. Here's the S&P making a new all-time high. The high in January of 2022 was 48.18. So it's 120 some points above that, which is what, 3% or so. The Russell's down about 19% from its all-time high. The value line's down 16%. So, looking at the breadth today and seeing how concentrated the buying is in Meta, Amazon, small number of stocks, that is not a healthy sign. Now, can it continue? Yes. My belief is, I think we're near at least a short-term top in the next day or so, and a pullback towards 4,800 is likely. And, is it possible that we could have a pullback to 4,600? Yes. Could it go below 4,600? Yes. So to me, this is a good place to aggressively lighten up, and for the not faint of heart to take at least a small short position, because I think things are set up for at least a pullback, at minimum is 4,800. Well, that's 130 S&P points, and potentially it could turn out to be much deeper than that. We'll take it one leg at a time.
All right. Well, the last chart you brought, Jim, was the Qs. So,
Yeah.
what do you make of this? I mean, obviously,
It,
you
it,
had some big earnings last night. You had
yeah.
Meta, it's up 20%. Amazon's up 8% at the time of me speaking. I can look at it.
Yeah.
Microsoft is up another 1.5%. Apple recovered its losses. So
Right.
Qs look good.
Yeah. Well, again, from the January 5th low, 1, 2, 3, the ABC down to the wave 4 low on Wednesday. And, I did a couple tweets yesterday with these charts, basically saying, in the chart on the S&P I sent out it was only up about 10 points when I sent that out. Like, okay, we got a wave 4, should rally above 48 or 49.31, which was the prior high. Then I did the Qs, should get above the 429.85. Two legs are equal, wave 1 and 5 at 432 and change. So again, to me, these two patterns are very similar in terms of the S&P's pattern and the Q's pattern, and that makes sense. 30% of the S&P are these mega cap stocks. So, I think in the wake of this great news on these companies, if Treasury yields continue to climb, as I expect the chart of TFT suggests, sometime early next week, it's going to be, wait a second, when Treasury yields go up, that's not good for the mega cap stocks because they have such high PEs. So we're basking in the glow of earnings today. I think potentially as we get into next week, if Treasury yields indeed do tick a little bit higher, people are going to kind of like, oops, maybe it's time to take some money off of Meta, which is up 20%. And you know what I'm saying?
Well, I mean, it makes sense logically to me. Well, I guess we'll have to see.
Markets are always logical.
The market has defied logic for a while. Jim, it's amazing to watch this market and watch all these mega stocks. It is very reminiscent of those of us that traded in the late 90s when you would see .com stocks driving the majority of the market. And, you're like, do these companies make money? Where are the revenues? And we're having the same conversations 25 years later, but sometimes it takes a new generation of traders to come in to have the same conversation.
Well, things are always different by a little bit. And so obviously the big difference between 99 is a lot of those companies didn't make any money.
True.
These big companies, I think if you subtract the earnings from the top 7 companies or so, from total earnings, S&P earnings would be down. So again, this gets to why is the Russell acting poorly? Why is the overall market not participating at the same level? It isn't just, everybody's just so focused on the mega cap stocks. They're taking that view in part because these companies are making a lot of money. And a lot of other companies aren't. And so, that's some of the logic of why people can justify, continuing to buy these stocks because, hey, it's true. They're making money. My point is, like in 2000, 2001, because I was writing letters back then, was at some point in time, as the economy slowed, the companies that buy the products and the people who buy their products are going to be impacted by an economic slowdown. So all of a sudden, the revenues for some of these big companies are going to slow. Instead of 25%, maybe it's 10 to 15. Still great relative to everybody else. But that deceleration in revenue growth will equate at some point in time to a significant decline in those stock prices. We're not there yet.
Yeah.
But I think that's what's coming as we look out over the next 12, 18 months.
Well, thank you, Jim, every week for guiding us. Really appreciate it. And I know our traders at home do as well and in their offices. And if you do, make sure you give Jim a big thumbs up. But more importantly, email Jim and ask about what he does. So, Jim, tell us a little bit about what you do.
Well, what do? I write a monthly letter, Macro Tides, and then a weekly technical review every Monday. And you can go to macrotides.com. You can send me an email if you'd like to see a recent letter. I'm happy to send that out as well. And if you like the content, I think Blake and I are delivering some good information every Friday. Pass it along to friends, that are involved with markets and so forth, because I think some of the stuff that we're doing also falls into the category of educational. And I think for most people, we all need to learn more. That's how we can get an edge when we invest and trade in markets. So anyway, appreciate it. We got a faithful following that are watching. Much appreciated. Just spread the word a little bit. That'd be great.
That would be greatly appreciated. I'm just here for the ride, buddy. So thanks for driving. All right, Jim, have a great weekend. And I'll look forward to speaking with you next week. And thank you all for listening in. Have a great weekend. Talk to you soon.
Thank you, Blake.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.